America just crossed $34 trillion in national debt. But that's not the real story. The real story is what just happened quietly behind the scenes, something that signals we may have entered phase 2 of a long-term financial shift. And almost nobody is talking about it, because while headlines focus on politics, the bond market is sending a very different message. And if you stay with me, I'll show you why the next 12 to 18 months could look very different from what most people expect. But first, we need to understand why $34 trillion isn't just a number, it's a trigger. And what happened after we crossed it is where this becomes serious. We'll break that down in a moment. The US has had debt before. After World War II, debt surged. After 2008, debt surged again. After 2020, it exploded. So why is this time different? Because now interest rates are no longer near zero, and that changes everything. When rates were low, the government could borrow cheaply. Now, interest payments alone are approaching levels that rival major federal programs. Think about that. We're not just borrowing more, we're borrowing at higher costs. And this is where phase 2 begins. Because when interest becomes one of your largest expenses, you enter a different economic environment. But here's the part most people miss. It's not just the size of the debt, it's who is buying it and who isn't. And that's where things start to shift. For decades, foreign governments and institutions were major buyers of US debt. China, Japan, global central banks. But recently, demand patterns have changed. Some foreign buyers have reduced purchases. Some are diversifying reserves. Some are selling, which means more debt must be absorbed domestically, and that creates pressure because if demand weakens while supply increases, yields rise, and rising yields ripple through. Mortgage rates, business loans, corporate refinancing, stock valuations. This is not theoretical, it's already happening. But here's where it becomes phase 2. The Treasury now has to refinance massive amounts of existing debt at today's higher rates. That rollover effect compounds the pressure, and markets are starting to notice, but they're not reacting loudly. They're reacting quietly. And quiet shifts are often more dangerous than loud ones. The stock market gets headlines. The bond market sends signals. Right now, long-term Treasury yields remain elevated compared to the past decade. That means investors are demanding higher compensation to lend money long-term. Why? Because risk perception is shifting. And when long-term borrowing costs stay high, it affects everything. Corporate earnings, housing, consumer spending, government budgets. But here's the deeper layer. If yields stay elevated, it forces hard decisions. Raise taxes, cut spending, print more, or accept slower growth. None of those are painless. And that's why this phase matters. Because structural pressure builds slowly, then adjusts suddenly. And history shows those adjustments are rarely gentle. Here's where most investors get it wrong. They assume high debt automatically equals immediate crash. That's not how it works. Debt stress changes valuation dynamics. When yields rise, future earnings are discounted more heavily. That pressures high-growth stocks. Liquidity tightens. Speculative excess fades. Markets don't collapse overnight. They rotate. They reprice. They become selective. This is why some sectors outperform while others struggle. And this is why understanding phase 2 isn't about fear. It's about positioning. But positioning for what? That's the key question. And it depends on whether this becomes a slow grind or a policy pivot moment. Here's the wild card. If debt servicing becomes too heavy, policymakers may eventually face pressure to ease conditions. That could mean rate cuts, liquidity injections, or fiscal adjustments. But timing matters. If they ease too early, inflation risk. Too late, economic slowdown deepens. And markets try to front-run these decisions. This creates volatility, but also opportunity. Because capital flows ahead of policy shifts. Smart investors watch bond yields, liquidity indicators, credit spreads, and dollar strength. Phase 2 isn't panic, it's transition. And transitions create both winners and losers. The question is, are you watching the right signals? Zoom out. Debt rising, interest costs climbing, yield pressures, policy constraints. This doesn't guarantee collapse, but it signals structural adjustment. Phase 2 means markets become more sensitive, liquidity matters more, valuations compress, and macro dominates narratives. The easy money era changes, and disciplined capital allocation becomes more important than hype. So what should investors focus on? Balance sheets, cash flow strength, sector rotation, risk management, not fear, not denial, preparation. Because systems don't usually break instantly. They tighten, they strain, and then they reset. And that reset moment, it rarely announces itself loudly. It starts quietly. Just like this shift did. If you found this breakdown valuable, subscribe. Because this channel exists to decode these macro shifts before they become headlines. And in the next video, we'll examine the bond market signal that could confirm whether phase 2 is accelerating. Stay ahead.